Most traders say they understand losses. They expect them. They even plan for them. But when a loss actually happens, something changes. The reaction is rarely neutral. It tightens the chest. It shortens patience. It lingers longer than it should. I've noticed this pattern repeatedly. Losses don't register as information. They register as something closer to rejection. And that's the part most traders don't consciously examine. A losing trade doesn't just feel like a bad outcome. It feels like a judgment. Not on the setup, not on the conditions, on you. This is why the emotional response often arrives faster than logic. Before the mind can review context, the body reacts as if something personal has been taken. What makes this confusing is that trading is framed as objective. Numbers, charts, rules, yet the internal experience is anything but. A loss can quietly trigger thoughts that never appear on the chart. I should have known. I missed something. I'm not as disciplined as I thought. Even when the trade followed every rule, that contradiction creates tension. If the process was correct, why does the outcome feel like failure? I've seen traders who can explain probability perfectly, yet still replay a single loss for days. Not because it damaged the account, but because it damaged their sense of competence. Losses don't hurt because they reduce capital. They hurt because they threaten identity. Trading attracts people who value control, foresight, and precision. So, when a trade fails, it quietly challenges those traits. The mind doesn't say, this is variance. It says, what does this say about me? And once that question appears, the loss is no longer contained. It spreads. The next trade carries pressure. The chart feels louder. Every fluctuation feels like confirmation or accusation. At that point, the loss is no longer just in the past. It has become a lens. What's uncomfortable is how subtle this shift is. Most traders don't notice when a loss stops being data and starts being narrative. They just feel off, more reactive, more urgent, less patient. The loss becomes personal because trading is not just an activity. It's a performance environment. Each decision feels observable, even when no one else is watching. And when performance dips, self-trust dips with it. I've personally had losses that didn't change the numbers meaningfully, but changed how I looked at the screen the next day. The chart felt less like a map and more like a test. That's the signal most traders miss. When the market starts to feel evaluative instead of conditional, something internal has shifted. Losses feel personal because they collide with expectation. Not the expectation of profit, but the expectation of control. Most traders don't consciously say this, but they operate as if correct behavior should produce protection from pain. So when pain arrives anyway, it feels unfair. And unfairness always feels personal. This is why even experienced traders can spiral after normal losses. The intellect understands randomness. The nervous system does not. The nervous system only knows exposure, risk, threat. A losing trade activates the same circuitry as social rejection or public failure. The body doesn't distinguish between financial feedback and personal judgment. That's why the urge to act appears immediately after a loss. To correct, to prove, to restore equilibrium. It's not about money in that moment. It's about repairing a crack in self-image. Until that's acknowledged, losses will continue to feel heavier than they statistically are, not because the trader lacks discipline, but because they are knowingly treating the market as a mirror. And mirrors don't just reflect results. They reflect how you think you should be doing. To understand why losses feel personal, you have to look at how the brain assigns meaning under uncertainty. The trading environment is incomplete by nature. You never have full information. Outcomes are delayed. Feedback is noisy. In those conditions, the brain fills gaps with interpretation. It doesn't just ask, what happened? It asks, why did this happen to me? This is not a flaw. It's a survival mechanism. Humans evolved to detect patterns quickly, especially when resources or status are threatened. A loss triggers that ancient system. The problem is that markets don't provide clean explanations. So the brain substitutes internal ones. If the outcome is negative and the cause is unclear, the default assumption becomes self-attribution. I missed something. I misread the situation. I wasn't sharp enough. Even when the trade was random within a valid edge. I've watched traders meticulously journal setups, only to abandon the journal after a drawdown, not because it lacked value, but because reviewing it felt emotionally exposing. Losses feel personal because the brain links outcome with agency. If I chose this, then the result reflects me. This is compounded by effort. The more time a trader spends analyzing, preparing, and waiting, the more invested they become. Effort creates ownership. Ownership intensifies emotion. So when a loss occurs, it's not perceived as external noise. It's perceived as wasted intention. Another layer is expectation asymmetry. Most traders intellectually accept that losses are part of the process. But emotionally, they expect competence to reduce pain. When that expectation is violated, the brain looks for a reason. And the easiest reason is the self. There's also the illusion of near misses. Markets often move close to targets before reversing. That proximity amplifies personalization. The brain says, I was almost right, which quickly becomes, I should have been right. Near misses increase emotional charge more than clean losses. They suggest preventability even when none exists. This creates a loop. Loss, self-attribution, pressure, impaired decision-making, further losses. Not because the trader forgot their rules, but because their internal state shifted. I've noticed that after a loss, many traders subtly change their posture. They lean closer. They stare harder, as if intensity can compensate for uncertainty. That physical shift reflects a psychological one. The trader is no longer operating a process. They are defending an identity. This is where revenge trading is misunderstood. It's rarely about anger. It's about restoration, restoring confidence, restoring self-trust, restoring the feeling of being capable. Losses feel personal because they interrupt narrative continuity. The story of I know what I'm doing takes a hit, and humans are narrative-driven. We don't experience events in isolation. We experience them as chapters. A loss feels small when it fits the story. It feels large when it contradicts it. The more rigid the self-image, the more painful the contradiction. That's why newer traders sometimes recover emotionally faster than experienced ones. They haven't yet fused identity with outcome. Experience brings skill, but it also brings expectation. And expectation creates vulnerability. Understanding this mechanism matters because it reframes the problem. The issue is not emotional weakness. It's emotional misplacement. Losses feel personal because the brain treats them as evaluations rather than samples. Until that framing changes, no amount of strategy refinement will fully solve the problem. Control doesn't come from suppressing emotion. It comes from redesigning what the loss represents. The goal is not to feel nothing. The goal is to feel correctly. The first shift is structural. Losses must be operationally depersonalized before they can be emotionally neutralized. That starts with constraints. When rules are vague, losses feel personal because responsibility is diffuse. When rules are precise, responsibility becomes procedural. Instead of I lost, the frame becomes this outcome occurred within defined conditions. That subtle shift matters. I've found that traders who predefine invalidation feel less emotional weight after losses, not because they're detached, but because the outcome has a container. The second shift is temporal. Losses hurt most when evaluated immediately. Immediate evaluation invites identity judgment. Delayed evaluation invites pattern recognition. Separating execution from review reduces personalization. Execution is mechanical. Review is analytical. When those bleed together, emotion floods both. The third shift is environmental. One simple strategy framework is enough not to generate profit, but to generate discipline. A framework with clear conditions for participation and non-participation reduces self-blame. The strategy's purpose is not to win. It's to say no consistently. When a trader knows exactly when not to trade, losses that occur during valid conditions feel expected even if they're unpleasant. That expectation softens personalization. Invalidation rules are critical here. A loss followed by a clear invalidation feels different from a loss followed by ambiguity. Ambiguity invites rumination. Clarity invites closure. I've personally noticed that when I stop engaging with charts outside defined windows, losses lose their echo. They end where they occur. That's the objective. Losses should end, not follow you into the next session, not leak into the next decision. Control is not emotional mastery. It's architectural design. Designing a system where outcomes do not have permission to comment on identity. When that design is in place, losses still register, but they don't attach. They inform without accusing. That's when trading stops feeling personal. Not because you care less, but because you care correctly. If this helped you see losses differently, support this perspective by subscribing or liking. It quietly helps this way of thinking reach traders who need structure more than motivation. This is Layer Trader.